Discover the secrets of Peter Lynch's success in the world of investments. He reveals strategies for small investors to thrive, challenging the belief that only institutions dominate the market. Learn why Lynch advises deeply understanding your investments, focusing on smaller companies, and having a strong stomach for volatility. Curious to see how these tips can transform your financial journey? Watch the video until the end to unravel Lynch's valuable lessons. Subscribe now and dive into the investment universe with the beginner's key, Peter Lynch: How to Invest for Beginners. 5. Peter Lynch believes that small investors can do well in the stock market, and the dominance of institutions is an advantage for them. Renowned investor Peter Lynch highlights the conviction that small investors can prosper in the dynamic stock market scenario. Contrary to the popular conception that financial institutions hold supremacy, Lynch sees this dominance as a favorable opportunity for smaller investors. He argues that by acting independently and having a solid understanding of the industries they invest in, individual investors can gain significant advantages. Lynch's emphasis on the importance of deeply understanding portfolio assets is notable. He points out that the ability to explain simply and concisely why you hold a particular asset is crucial. Lynch suggests that if an investor can't convey this explanation to a 10-year-old in 2 minutes or less, it might be wise to reevaluate the investment rationale. This seemingly simple approach serves as a valuable filter to ensure that investors are truly aware of what they hold in their portfolios. Investing in smaller companies is another strategy emphasized by Lynch. He highlights that during his management of the Fidelity Magellan Fund, he achieved impressive returns by identifying 10 baggers, stocks that increased up to 10 times in value. Lynch maintains that smaller companies, in general, have a more significant growth potential than well-known and established ones in the market. This strategic focus aims to capture opportunities in rising companies, providing investors with the chance to multiply their investments significantly. 4. Lynch emphasizes the importance of knowing what you own and why you own it. Investors should be able to explain their investments simply. The resonance of Peter Lynch's message about the importance of knowledge regarding portfolio assets is notable. He emphasizes that the ability to articulate clearly and succinctly the reason behind each investment is a critical skill. Lynch advises that if an investor cannot communicate this explanation in an accessible way, it may be indicative that a review of the investment justification is necessary. This fundamental principle reinforces the need for a deep and conscious understanding of held assets, promoting a more informed and resilient approach in the market. Lynch's approach resonates in the simplicity of the advice, as he emphasizes the importance of explaining investment reasoning at an understandable level, even for a lay audience. By simplifying the understanding of investments, Lynch not only highlights the investor's clear vision but also underscores the need for solid and logical fundamentals to support each position in the portfolio. This emphasis on simplicity serves as a valuable filter to ensure that investors maintain a strong and justified connection with their assets. Lynch's recommendation for investors to have the ability to express their investment choices in an accessible manner highlights the value of transparent communication. This skill not only strengthens the investor's confidence in their decisions, but can also play a crucial role in building a more conscious and disciplined approach to investments. Lynch, by emphasizing simplicity in explaining investments, promotes a clear and informed mindset among investors, contributing to a more solid and grounded decision-making process in the dynamic stock market. 3. The legendary investor recommends focusing on smaller companies for better growth potential, as they can become 10 baggers or stocks that increase 10 times in value. Peter Lynch's wisdom resonates in his emphatic recommendation to focus on smaller companies, a strategy aimed at unlocking vast growth potential. Lynch, with his vast experience, highlights that such companies have the ability to turn into true 10 baggers, stocks that witness an extraordinary increase of up to 10 times in their value. The emphasis on seeking opportunities in smaller companies reflects Lynch's understanding that, on average, these entities have a more significant growth potential compared to their larger and more consolidated counterparts in the market. The strategy proposed by Lynch to focus on smaller companies is supported by the solid logic that it is more feasible for a smaller company to multiply its value than for an already established and large one. Lynch takes a pragmatic approach by arguing that it is easier for a company to go from a market value of $1 billion to $10 billion than for a company to go from $100 billion to $1 trillion. This strategic view highlights Lynch's pursuit of more exponential growth opportunities, providing individual investors with the prospect of significantly amplifying their investments by identifying and investing in smaller companies with substantial growth potential. 2. Adopting a long-term approach is crucial, and Lynch explains how institutional investors' focus on short-term performance can create opportunities for individual investors. Peter Lynch's vision highlights the fundamental importance of adopting a long-term investment approach. Lynch emphasizes that this broader time perspective is essential to allow investors to reap the full benefits of their investments. He argues that the relentless focus of institutional investors on short-term performance can, in fact, create valuable opportunities for individual investors who have the ability to look beyond the momentary fluctuations of the market. The stadium analogy Lynch employs serves to illustrate how, just as ticket prices in a stadium are influenced by momentary demand, stock prices are also susceptible to variations based on the current demand for these assets. The massive fund management by financial institutions can result in significant fluctuations in stock prices in response to short-term concerns. Lynch highlights that this dynamic, often motivated by short-term goals, can create opportunities for individual investors who maintain a broader perspective and are not disturbed by temporary market movements. By embracing a long-term mindset, Lynch not only encourages resistance against impulsive reactions to momentary declines in stock prices, but also suggests that such moments of volatility can be exploited as buying opportunities. His strategic approach highlights the importance of maintaining a firm view regarding long-term investment goals, allowing individual investors to take advantage of short-term fluctuations created by institutional focus on immediate results. 1. Lynch advises accepting declines in stock prices and emphasizes the importance of having a strong stomach for market volatility. The prominent advice of Peter Lynch underscores the need for investors to be prepared to face declines in stock prices, emphasizing the importance of cultivating financial resilience in the face of market volatility. Lynch points out that, in many cases, volatility is inherent in the stock market environment, and individual investors should embrace a mindset that empowers them to face these fluctuations with firmness. The metaphor of the strong stomach that Lynch employs suggests the idea that the ability to withstand market oscillations is as crucial as technical or fundamental analysis. He argues that risk aversion often prevents investors from seizing valuable opportunities, especially during temporary declines in stock prices. By emphasizing the need to have a strong stomach, Lynch not only highlights the importance of staying calm amid uncertainty, but also encourages investors to view volatility as an intrinsic part of the investment process. Lynch's approach suggests that individual investors can benefit by resisting the temptation of impulsive reactions to momentary declines in stock prices. Instead of being motivated by fear or risk aversion, he proposes that investors cultivate the resilience needed to remain focused on their long-term goals. This mindset, according to Lynch, not only helps mitigate the emotional impact of market fluctuations, but also enables investors to take advantage of opportunities that may arise during periods of volatility. Incredible, isn't it? Now that we've absorbed Peter Lynch's wise words on investing, it's time to take action. If you value these valuable tips, don't forget to subscribe to the channel for more financial insights. Give a like if these strategies make sense to you, and share in the comments your opinion or your own investment experiences. Let's build a community of conscious investors. Together, we can thrive in the financial market. Subscribe, leave your like, and share your thoughts in the comments. Until the next video.